Propelled by the sudden shock of a dramatic military move that stunned the world, today's story begins not in whispered rumors, but in the loud tremors of real global impact. A sweeping U.S. operation deep inside Venezuela's borders resulted in the capture of its longtime president, and has set off a series of reactions that have the potential to reshape not just one country's future, but the global economic landscape itself. In this video, you will learn why experts are talking about a massive shift of wealth, how control over the world's largest proven oil reserves suddenly changed hands, and what this means for markets, nations, and everyday life around the globe. You will discover the lesser-known economic forces at play, including how access to Venezuelan oil could redirect billions in future revenue, why major energy companies are watching closely as opportunities unfold, and how geopolitical alliances are being tested by this high-stakes confrontation. Stay with us as we untangle complex economic and political threads in a way that is clear and easy to understand, because by the time this video ends, you will have a strong grasp of why this event is being called one of the most significant turning points in global wealth dynamics in decades, and what could happen next to the world's power balance, energy markets, and financial futures. You'll hear about the deeper connections between resource control and influence in world affairs, the unexpected winners and losers emerging from this tense encounter, and the real implications for countries that rely heavily on Venezuelan oil. What started as a strategic mission now appears to be triggering economic effects that reach far beyond borders, touching investors, consumers, and policymakers alike. You should watch until the end because we will break down complex ideas into simple explanations, reveal surprising facts that most people are not talking about, and help you see the full picture of how this single raid may be linked to one of the largest transfers of wealth in modern history. Welcome to the channel, and if you find this kind of deep, clear analysis useful, make sure to subscribe and join our community for more insightful breakdowns of the events that shape our world. Momentum shifted fast when reports emerged of a decisive U.S. operation inside Venezuela that removed the country's sitting president from power and placed key state functions under external control, an action that instantly reframed the political and economic map of the region. The operation, described by officials as a targeted mission designed to neutralize leadership and secure strategic assets, unfolded with speed and precision, leaving little time for internal resistance, and even less time for global markets to process what had just happened. Within hours, attention moved from the military aspect to the economic consequences, because Venezuela is not just another nation in crisis. It sits on a foundation of resources that quietly influence the world economy. With the leadership removed, access to state-controlled assets shifted, and among the most sensitive of those assets were oil infrastructure, export contracts, and financial holdings that had been frozen or restricted for years. The name of the operation quickly circulated across newsrooms and trading floors, not because of its military complexity, but because of what it unlocked. Oil terminals, refineries, shipping agreements, and overseas accounts tied to Venezuelan crude suddenly became the center of global focus. Traders, analysts, and governments understood that this was not simply a political event, but a trigger that could redirect flows of money, energy, and power. Markets reacted cautiously at first, then with growing intensity as energy prices adjusted and investors reassessed risk across the oil sector, emerging markets, and even digital assets connected to state reserves. Venezuela's importance becomes clear when its economic weight is stripped down to fundamentals. The country holds the largest proven oil reserves on the planet, a fact that places it in a unique position even among energy-rich nations. Oil is not just fuel, it is leverage. It supports currencies, funds governments, shapes alliances, and influences inflation far beyond the borders of the countries that produce it. When oil flows smoothly, economies stabilize. When oil is restricted, prices rise and power shifts. For years, Venezuelan oil existed in a kind of economic limbo, abundant but constrained by sanctions, mismanagement, and political isolation. Control over such reserves represents control over future income, and future income is a form of wealth that markets price instantly, even before a single barrel moves. When a major producer experiences a sudden change in control, money does not wait for long-term confirmation. Capital moves quickly, pricing in new expectations, new access, and new risks. That speed is why this moment matters, because it compresses years of economic change into days or even hours, and that compression creates winners and losers almost overnight. The discussion around what was transferred or could be transferred centers first on oil itself. With leadership removed and oversight altered, the possibility of redirecting millions of barrels of oil into global markets moved from theory to expectation. Oil exports at that scale translate into billions in revenue over time, and more importantly, they shift who decides where that oil goes, at what price, and under which currency terms. This is not just about physical barrels moving from ports to tankers. It is about pricing power and influence. When access expands, supply dynamics change, and when supply dynamics change, benchmarks respond. The authority to open or close production taps carries enormous weight, and that authority defines long-term wealth far more than a single transaction ever could. Energy markets began recalibrating as soon as this possibility entered serious discussion, reflecting not just optimism but strategic anticipation of sustained production increases. Alongside state control, private energy companies entered the picture almost immediately. Firms that had long maintained limited or suspended operations in Venezuela suddenly faced the prospect of renewed access. Chevron, Exxon, ConocoPhillips, and others with historical ties or technical capacity to operate heavy crude fields became central to investor conversations. The idea was simple. If political barriers fall, technical expertise returns, production rises, and revenue follows. Energy stocks reacted accordingly, reflecting expectations rather than confirmed outcomes. Markets do not wait for certainty, they trade on probability. Even the hint that Venezuelan oil could re-enter global circulation at scale was enough to lift valuations across parts of the energy sector. This reaction alone represents a form of wealth transfer as capital reallocates toward assets perceived to benefit from the shift, leaving others behind. Beyond oil, quieter conversations focused on financial reserves that may exist outside traditional systems. Reports circulated suggesting that Venezuela had accumulated significant digital assets, including large Bitcoin holdings, as part of efforts to bypass sanctions and maintain liquidity. While these claims remain difficult to verify, their potential impact is undeniable. Digital reserves at that scale would represent tens of billions in value, and control over them would mean control over highly liquid, globally transferable wealth. Unlike oil, which requires infrastructure and logistics, digital assets move instantly. If such reserves exist, and if access changes hands, the shift would be immediate and irreversible. Even the possibility of this scenario influences market psychology as traders and analysts consider how non-traditional state assets factor into modern power dynamics. Understanding how all of this translates into a wealth transfer requires looking at the process step by step. Political change alters authority. Authority determines who controls assets. Asset control opens or closes markets. When markets open, sales begin. When sales begin, revenue flows into new channels. As revenue flows, investors respond. Prices adjust. Capital moves. This chain reaction does not depend on ideology or intent. It is mechanical. Wealth shifts not because someone declares it, but because systems respond automatically to new conditions. Banks reassess exposure. Funds rebalance portfolios. Governments renegotiate contracts. Each action compounds the next, creating momentum that is difficult to reverse once it starts. Oil access sits at the center of this mechanism because it connects physical resources with financial systems. Contracts are rewritten, shipping routes are reconsidered, insurance premiums adjust. Each adjustment carries a cost or a benefit, and those costs and benefits accumulate across the global economy. Revenue that once remained locked now appears reachable. That expectation alone increases the perceived value of assets tied to production, transportation, and refinement. Investors who position early capture gains. Those who hesitate absorb losses. This is how wealth moves without a single dramatic transfer of cash from one vault to another. At the same time, currencies feel pressure. Oil sales often influence which currencies are used in trade, and shifts in supply can reinforce or weaken demand for those currencies. When production expands under new control, payment systems adapt. This adaptation influences exchange rates, reserves, and monetary policy in countries far removed from the original event. The ripple effect spreads outward, touching everything from fuel prices to inflation expectations. None of this requires a formal declaration of a wealth transfer. It happens because economic systems are interconnected, and a change at one node propagates through the network. Investor behavior amplifies the process. Markets are forward-looking by nature. As soon as the possibility of sustained Venezuelan oil output under new oversight entered serious discussion, capital began repositioning. Energy funds adjusted exposure. Emerging market risk premiums shifted. Even unrelated sectors felt indirect effects as money moved from perceived risk to perceived opportunity. This reallocation is subtle but powerful, and over time it defines who holds value and who does not. Digital assets add another layer. If state-linked digital reserves are confirmed, they represent a new kind of sovereign wealth, one that bypasses traditional gatekeepers. Control over such assets would mean immediate access to liquidity without reliance on banks or clearing systems. That potential changes how analysts think about sanctions, reserves, and financial sovereignty. It also introduces volatility, because digital markets respond instantly to news and speculation. Even unverified reports can move prices, creating temporary transfers of value that become permanent for those positioned correctly. All of these elements combine into a single process driven by access, control, and expectation. Political change opens doors. Resources define leverage. Markets translate leverage into value. Value attracts capital. Capital movement completes the transfer. There is no single moment when wealth changes hands, but rather a continuous flow that accelerates as confidence builds. This is why the event matters beyond headlines. It sits at the intersection of power and economics, where decisions made in one place alter outcomes everywhere else, and where the quiet mechanics of markets transform political actions into lasting financial consequences. Pressure began spreading outward almost immediately as the global economy started responding to the sudden change in access and control over Venezuelan resources, and the first place this pressure appeared was in oil prices and trade expectations. Oil markets are extremely sensitive to supply signals, even before real barrels reach ports, because traders price the future, not the present. The possibility of increased Venezuelan supply entering the global market altered expectations around scarcity, balance, and leverage. More supply does not always mean cheaper oil right away, but it reshapes negotiations, contracts, and long-term outlooks. Buyers gain options. Sellers lose exclusivity. Shipping routes adjust. Insurance costs change. Refineries reconsider blends. All of these small adjustments accumulate and slowly influence prices across regions. Even countries that do not directly import Venezuelan oil feel the effects through benchmark pricing, because global oil is interconnected. A shift in one producer changes assumptions everywhere else, and those assumptions guide decisions that affect energy costs, transportation expenses, and industrial production worldwide. Trade dynamics also begin to shift as access changes. Countries that once relied on limited suppliers now see potential diversification. This weakens monopolistic power and strengthens buyers' negotiating positions. Long-term contracts come under review. Spot markets gain importance. Strategic reserves are reassessed. For energy-importing nations, even the possibility of additional supply improves confidence and reduces urgency, which can cool speculative pressure. For exporting nations, increased competition forces efficiency and pricing discipline. These changes do not happen overnight, but they start forming the moment expectations change, and they continue unfolding as political and operational clarity improves. Countries closely tied to Venezuelan oil feel a deeper impact. China stands out as a major player, having invested heavily through loans, infrastructure deals, and long-term supply agreements. When political control shifts, exposure becomes a question that banks and policymakers cannot ignore. Financial institutions reassess risk tied to outstanding loans, repayment terms, and asset-backed agreements. Credit exposure is reviewed. Collateral assumptions change. This reassessment can tighten or loosen capital flows depending on perceived outcomes. Even without immediate losses, uncertainty alone can freeze decisions, slow investment, or trigger renegotiations. For China, this is not just about oil supply, but about influence, repayment security, and strategic positioning in a changing environment. Banks play a quiet but powerful role in this process. They act as filters between political events and economic reality. When risk profiles change, lending conditions adjust, interest rates shift, access to credit expands or contracts. Companies operating in or around Venezuela feel this shift first, but the effect spreads outward through supply chains and financial networks. A single reassessment can influence dozens of related industries, from shipping to insurance to refining. This is how ripple effects grow wider, without drawing much public attention. Currency dynamics add another layer. Oil trade has long been tied to currency influence, especially the role of the dollar in global energy transactions. If changes in control alter who buys Venezuelan oil and how payments are settled, currency demand patterns may shift. Even small adjustments in settlement currency can have symbolic and practical consequences. Demand for certain currencies strengthens or weakens based on trade flows, and over time this affects reserves, exchange rates, and monetary policy decisions. Influence in global trade is not just about volume, but about denomination. Whoever sets the terms gains leverage that extends far beyond the transaction itself. Power follows these flows quietly. When resource control shifts, so does negotiating strength. Countries with access gain flexibility. Countries without it lose leverage. Alliances adjust subtly as energy security priorities evolve. None of this requires confrontation or public declarations. It happens through contracts, pricing, and long-term planning. This quiet redistribution of influence is one reason why some experts frame the situation as a form of wealth transfer, even though no single account shows a dramatic balance change overnight. The idea of a wealth transfer here is not about trucks moving gold or bank accounts being emptied. It is about control over resources that generate future income. When control changes, the right to decide how and when value is extracted also changes. That right has economic weight. Markets recognize it. Investors price it in. Asset values adjust based on who holds authority and how stable that authority appears. A refinery, an oil field, or a shipping terminal becomes more valuable or less valuable depending on governance, access, and predictability. These revaluations are how wealth shifts over time, quietly but persistently. Future revenue streams matter more than current cash. Oil fields represent decades of potential income. Whoever controls them influences not just today's prices, but tomorrow's supply. This influence attracts investment, technology, and partnerships. It also deters rivals. From a market perspective, that control is wealth, even if it has not yet been converted into cash. When analysts talk about a wealth transfer, they are often referring to this shift in long-term earning power rather than immediate financial movement. Markets and investors respond quickly to perceived power changes. Stocks tied to energy production, services, and logistics react. Bonds adjust as risk premiums change. Currencies move as capital flows respond. These reactions create winners and losers based on timing and exposure. Early movers benefit, late responders absorb losses. Over time, these cumulative adjustments represent a redistribution of value across the financial system. It is not centralized. It is distributed through millions of individual decisions driven by new expectations. At the same time, skepticism remains strong, and it plays an important role in balancing the narrative. Some analysts argue that calling this the biggest wealth transfer exaggerates uncertain outcomes. Control on paper does not always translate into effective control on the ground. Legal challenges can delay access. Diplomatic resistance can complicate agreements. Operational realities can limit production increases. Infrastructure damage, workforce constraints, and regulatory hurdles all slow progress. Markets may price in optimism, but reality often unfolds more slowly. International law adds complexity. Asset ownership, contracts, and sanctions frameworks create legal boundaries that cannot be ignored. Disputes may arise over who has the right to sell, manage, or profit from resources. These disputes can freeze assets, delay transactions, or reduce expected gains. Even powerful actors must navigate these systems, and missteps carry financial and reputational costs. This uncertainty tempers expectations and reminds investors that not all projected value will be realized. Diplomatic reactions also matter. Other nations may challenge legitimacy, impose conditions, or push back through economic or political channels. These responses influence timelines and outcomes. Wealth that appears transferable in theory may remain locked in practice due to prolonged negotiations or resistance. Markets eventually adjust to this reality, sometimes reversing early gains or redistributing value again. Risk perception evolves over time. Initial excitement fades. Details emerge. Assumptions are tested. Some investments prove justified. Others do not. This natural correction process is part of how markets function. It prevents narratives from becoming detached from reality, and it ensures that value ultimately aligns with sustainable outcomes rather than short-term speculation. Despite skepticism, the broader idea persists because control and access remain central to economic power. Even partial shifts influence long-term trajectories. Even delayed access alters expectations. Even uncertain outcomes change behavior. This is why the term wealth transfer continues to circulate. It captures the sense that something fundamental has changed, even if the final shape of that change is still forming. As events continue to unfold, markets remain alert, governments stay cautious, and institutions adjust quietly. The ripple effects keep moving outward, touching sectors far removed from oil headlines. Transportation costs, manufacturing inputs, and consumer prices feel subtle pressure. Investment strategies evolve. Policy discussions shift tone. None of this is dramatic on its own, but together it forms a slow-moving transformation driven by altered control, redefined access, and reweighted power across the global economic system. Now, as we look back on everything we've explored in this video, it's clear that the US raid in Venezuela was far more than just a dramatic headline or a flashpoint in geopolitics. That operation shifted power structures in a way that few expected, moving control of one of the world's most oil-rich nations into new hands and redirecting how capital, influence, and future wealth may flow across global markets. What once seemed like an isolated event now has ripple effects stretching into oil pricing, trade relationships, currency influence, and the strategies of banks and nations tied to Venezuela's vast reserves. Control over resources and the future income they generate has changed hands, and markets and investors are already adjusting their expectations in response. At the same time, experts remind us not to overstate what has happened, because the legal, diplomatic, and economic realities are still unfolding and could temper or reshape what looks like a historic shift today. But whether the movement of capital and power we've just walked through becomes one of the largest wealth transfers in history, or simply the start of an even larger global realignment, is a question that will be answered in the years ahead. So we want to hear from you. Do you think this moment marks the beginning of a new era of global power? Or is it just the opening chapter in an even bigger story yet to be written? If you found this video insightful, take a moment right now to like it, share it with others who follow global news and economics, and subscribe to our channel so you never miss another deep dive into the events shaping our world. Your support helps us bring more clear, compelling explanations like this one right here every week.